Hi, I am Darryl Rosen, the financial strength coach. I make these videos to help people like you create more safety, simplicity, and most of all, financial strength at any age or stage of your journey through life. I have a very special guest right on the line with me, on the other side of the screen, an extraordinarily good-looking man who happens to be the chief investment officer at the company that holds my license. So let me explain that for a second. I am an independent advisor. And essentially, the company that holds my license has an investment committee, and they come up with strategies and models that I share with my clients. And Mark heads that whole team up. So, Mark, thank you for being with me today.
Great to be here. Thanks, Darryl.
Is it really great to be here, Mark? I think
it is. It's a great. We were making it through a very challenging year for sure.
Okay. Okay. So we talk all the time about markets, and so it has been a challenging year. We talk about the recovery, and sometimes there's something known as a V recovery where it goes right down and it comes right back up. And that would be more like what happened after COVID. And then there's other kinds of recoveries, which there could be like a W where it would come down and go back up a little bit and then come down again and go back down. And I'd say maybe 3 weeks ago, I thought we were on better footing. And now we are not. So the $64,000 question, Mark, is why is it important for us to stay invested?
Sure. Well, the main reason to build an investment portfolio, and this gets lost a lot of times with all the news flow, and when markets are rallying sharply, you're thinking it's about making money, and then they're declining, you're trying to preserve principal and so forth. But really the main reason to build an investment portfolio is to preserve your purchasing power over time and then grow that purchasing power over time. And what that really means is build a portfolio that outpaces inflation over time. And so really when you're building that portfolio, that's what you're balancing against. You're really balancing the dual threats to an investor, which is one, volatility, and then two, which is the bigger one over time, inflation. So investments over time have actually proven to outpace inflation over time and essentially preserve your purchasing power over time. And this is a great chart that you just threw up, which shows that a number of different asset classes, and an asset class is a set of similar securities. So you have large cap stocks, for example, small cap stocks, international stocks, bonds. Each of those are asset classes. And what this chart is reflecting is the range of returns in any given year. So any year you could have the markets rallying sharply, you could have the markets declining because business conditions and the economy is weakening and so forth. Similar to this year, kind of a challenging year where you have this volatility, but the average return over time has really compensated investors at or above the inflation rate.
So when I first learned the business, I would, as I was educating myself, I came to the conclusion that because of inflation, and most years, Mark, inflation is not the way we've seen it this year. It's generally a lot lower. But when I was learning about investing and managing money, I came to the understanding that you really couldn't invest your way to a wonderful retirement. Certainly, we wanted to have our investments outpace inflation, and I think I love coming at it from that angle because what I believe and what I share with my clients is that there are really three ways to have a bigger nest egg in retirement. I think the first is when you're working, you earn more money. The second is that you save more money, and the third, and this is something that I talk all the time about, and it took me a while to learn this myself, was that we sort of train ourselves to want a little bit less. And so if we go back to this chart, this first one, when you look at inflation and you just look at what's happening right now, if you're not on Social Security, where you're, at least if you're 62, you're going to get that inflationary bump. I mean, the rest of us who are not 62 yet, our inflation, our cost of living, and for Social Security in the future is it's figured. There's this whole long formula, and nobody really understands it, but we certainly don't see that same effect. I'd like to share. We have one more chart and have you explain this. So share with the viewers how this chart works.
So this is looking at returns and risk over the last 20 years. And and it adjusts for your different risk profile. So one of the foundations that we determine when we showed that chart just moments ago about the different asset classes, stocks and bonds, the next question you ask is, well, what percent should I own in stocks? What percent in bonds? And that process is called asset allocation, where you want to build that portfolio to have the right mix that balances what you're comfortable with in terms of portfolio volatility and growth. But what this shows for any of the 5 major risk categories, conservative to aggressive, it's outpaced inflation over time. So you've had that positive return over time. And if you go back to think about over a 20-year time period, I know that sometimes it's hard to think about, but that's what an investment portfolio is about, trying to build an enduring portfolio that can get you to your long run goals and ultimately preserve that purchasing power over time. House prices have doubled over that time period. Car prices have more than doubled over that time period. And despite a global financial crisis, a global pandemic, and a number of other bumps along the way,
Right.
stock prices have more than tripled and almost quadrupled over that time period. So they've preserved your purchasing power over time despite all that volatility. So it really makes sense to build that investment portfolio, but have in mind why you're investing and what you're trying to achieve.
And how would you describe standard deviation to somebody who might be looking at this chart and remembers it from school? Like, what's a very simple way to
Sure.
explain standard deviation?
In the investment world, standard deviation is what we term risk, and that's the variance of returns around that mean. So if you look at the moderate portfolio, for example, the average annualized return is 7.7%, but the standard deviation is 10.6%. So what you would do is you'd add 10.6% from 7.7, and then you'd subtract 10.6 from that 7.7, and you get a range of returns, just rough sketch, between a negative 3% and a positive about 18%. That's a normal range of returns that you can expect in any one given year within what they call standard deviation. Right. So that's where it's not predicting a 1 year's return. It's saying, well, if you're anywhere within that, that's what we'd expect in a normal year. You could be down 2%, but you could be up 17%. And that's
Right.
just normal market gyrations.
And we always talk about low volatility investing and how our attempt is always to get, let's say 2/3 of the market upside, but maybe only half of the market downside. Can you briefly explain like why it's so important to not have big drawdowns of money?
Well, part of the reason that we want to balance the risk and reward appropriately is so the portfolio, and I mentioned the word enduring. In other words, can you manage through these big ups and downs and the different swings that the economy is going to go through? But really, why you reduce the risk in the portfolio is because it improves compounding. So if you have a wider standard deviation, the compounding of returns actually lags a little bit. Whereas if you lower that standard deviation, you can compound at a greater, faster rate. So that's really why we look at both, not just the return side, but also the risk side. And in addition, if you're withdrawing from the portfolio, you definitely want a lower volatility portfolio because then you're not withdrawing into major downturns, which would leave you with less of principal value, let's say, to bounce back on the eventual recovery.
I always shudder a little bit when I see my activity in the platform of, I mean, I don't have any clients that are super aggressively invested but the ones that are drawing out of their portfolios, when there's days of market activity where you really don't want to look, but yet I see their money coming out. So yeah, I mean, it's one thing that somebody who helps people plan for retirement, I always try to help others understand is that when you start to take money out, the rules are different. Let me ask you one final question, right? So my 27-year-old son is going to make his Roth IRA contribution right about now, and should I put it in the market now? What should I do now? And I'm saying, Josh, we really care what you're 27, okay? What happens when you're 62, 60? That's what we really care about. What's your position on so not necessarily in timing the market, because we don't believe with timing in the market. You have to be right twice, when it's going down and when it's going up. But what's your position on, like, is this a good time to put my $6,000 in the market, or should I wait till next week, or should I have done it last week?
Sure. I think you want to jump in when you're ready to jump into the market and be an owner of shares and investments. So, you can always play around, and I've seen it over and over and over 2 decades, trying to play around and put it in the right time. But markets move so fast. It was in mid-June where the markets, everything was negative, and all of a sudden the market turned around and rallied 15%. Not on much good news, but the markets do that because they anticipate going forward. So my point is, you want to be involved because those rallies and those markets can turn on a dime. You mentioned V-shaped recoveries. We don't know if we'll have a V-shaped recovery, but at some point the market does turn and moves very quick when it does turn. And so that's why you want to be in there as soon as you can to jump in and take advantage of some of the opportunities. And particularly now when you have that you have a down market.
Right.
So prices are lower than they were to start the year. So for new investments, for sure, there's opportunities.
Right. It's a great opportunity, and I tell him, because he'll ask me, he'll hold me accountable for this. I can't say that the market or that $6,000 investment wouldn't be worth less a month from now, but I can promise him, I guess, that 20 years from now it's going to be worth more. So.
Right.
Okay. Well, this has been very informative. I appreciate you jumping on with me. Have a wonderful holiday weekend.
Great. You too. Thanks, Darryl.
All right. Thanks. Bye-bye.